Hi, this is Todd with Integrity Investment Advisors. Just want to do a market update here for everybody. We've had a little bit of volatility as we started this summer. Newsflash, volatility is normal. It is the price you pay for excess returns and compounding over decades. So I'm going to walk you through some key slides. You can pause any of these if you want to see it in more detail. But it's super important for us to know and understand how markets work and why we're investing for the long term. So this slide has total returns for every year in this column, how the year finished or where it is today. And then DD is for drawdowns from the highs of that year. And you can see drawdowns are very normal, right? It's very normal for it to be down 5, 10, 15% in any given year. Some years are much worse. COVID down 33%. 2022 down 25% from all-time highs. So this is very normal, and even though it was an outsized day yesterday, we'll go through some of the reasons why and why we want to be, long-term investors. So what happened over the last several weeks and on August 5th is a growth scare, and I'm not sure if it's rational or not, but basically some of the equity indices have had a downturn of 10 to 15% plus. The S&P 500 is down about 8.5%. August is historically a light month with low trading volumes. And on days like Monday the 5th, a lot of the trading volume, probably 90% plus, is institutional and big computer programs that are de-risking portfolios. So they're basically selling a lot of equities and ETFs and things of that nature to de-risk the portfolios. And that's why you see large drawdowns from time to time. The July jobs report was concerned. Some of this was related to the hurricane down in Texas and people being out of work. So we'll see how that improves or doesn't over the next couple months. One of the other big things that happened was Bank of Japan raised their policy rates, and this trade for currencies and for lending and leverage really caused a lot of turmoil over in Japan. And sometimes that spreads to U.S. markets and to U.S. traders. Heightened political risk in the Middle East, and people over the last couple of weeks have been trading out of big cap technology. And then lastly, the presidential election has tightened up a little bit since the debates. So we continue to monitor these things. We think the Fed may end up cutting 3 to 4 times by the end of the year. But this is pretty normal. And again, when markets turn this way with a lot of computer trading, you can see down 2 or 3% easily in one day. So again, this slide has, since 2009 lows, all the 5% or greater drawdowns that have happened and sort of why they were falling at the time. So disappointing earnings, recession fears, something happening with Japan and so forth, down about 8.5%, 9% or so from the all-time highs. You can see there are 29 different occurrences since 2009, and the average days was about 52 days for a drawdown. But since 2009, stocks, S&P 500, are up 926%. Ag bond, if you wanted something safer, is only up 52%, and inflation is up 47%. So the difference between these two is not very much since 2009. So we really want to own equities, global equities, for the long term. So interesting, the 5th was one of the highest volatility days since COVID and since the great financial crisis, higher than many other past recessions. So it was a very big volume day and a rapid sell-off in the morning. It clawed its way back a little bit in the afternoon, even though markets were down. But this is normal, okay? Since 1993, the S&P has been down 330 times, more than 2% in a day. So when you're worried about markets, you please need to think about long-term buckets and short-term buckets. For our clients, if you're a client, we generally have a 0 to 4 year bucket, which is safer investments, high-quality bonds. We have a 4 to 7 year bucket, which is some balanced funds and some hedging and some puts and calls. And then we have long-term bucket, which is equities. And even though there was volatility on this day, for the last 7 years, global stocks are up 82% to 140%. So being down 2 or 3% in one day is no big deal. And it's very typical. In any given year, 5% pullbacks happen about 3 times a year. and once a year pullbacks of 10 to 15% are very normal. So we were, end of the day, very oversold and with a lot of fear in the marketplace. And normally this is a good time to start to rebalance, or if you have new money to add, we could be adding new money. And we did for some clients. So again, drawdowns are normal. I tell clients when they start with us, it's very typical for stocks in any given year to be down 15 to 35%. This is very normal from 2-year highs. What's not so normal is 2008, 2009, 2000, 1973. Those are not so normal. Those are big time recessions with a lot of problems. So we try to help clients focus on what you can control. And this is an important slide. You can pause it. But this is having an emergency fund, having safer assets, really in the 0 to 4 year bucket, and then 4 to 7 year bucket for when you need cash flow. If we're in a big recession, we're going to take your money you need from these safer buckets. Saving enough money. Most clients need to save between 15 and 25% per year of gross income. And then we work on things like how much equities do you need to have in your portfolio to hit your goals and your best life possible? Is it a 50-50 portfolio or 75% equities or something in between? Tax strategy, we're analyzing taxes for clients, starting to look at Roth conversions and other things like that to save you money on taxes. Planning, everything we do, stress testing your goals in your retirement is done in our planning software. We love it. It's Right Capital. It really helps you to figure out the different outcomes and stress testing for recessions and things like that. And then if you're worried, let's book a meeting. Book a meeting with myself or Sam, and we can talk about it and make sure you're well positioned. So those are the things to think about. You focus on what you can control, and then the market's going to take care of itself, and it really is out of your control what happens in the market. Again, there's always a reason to sell stocks. Stocks are typically up 6 out of 7 years. This is a chart that goes back to 1970. You can see all sorts of different problems and wars and terrorist events and bankruptcies, politics and everything. So markets tend to go up because earnings go up over time. And these companies are really well run, and they plan for recessions and they adapt to the changing markets. So again, stocks are typically up 6 out of 7 years, so invest for the long term. We tell clients average returns are, say, 8 to 12%, somewhere in here, but a lot of times markets are up much more, okay? And then sometimes they're down a lot, like 2008, 1974, 2000 to 2002. So in those times, we want to just buy more or rebalance or keep buying it so we can get more equities when they're on sale. So if you have questions, book a meeting with us. We have great software to model recessions. We do this for all clients. We can talk about high stock market valuations, your retirement date, spending in retirement, Roth conversion strategies. It's important to have a Roth conversion strategy. This will save you thousands, tens of thousands on taxes. If you have questions about annuities, we actually have access to commission-free annuities. We're not big believers in it, but some people have them already, and we can get you in a lower cost annuity. Social Security is actually your first and best annuity, so we can talk you through that. But don't believe the commercials or the annuity sales reps out there. Most of them are expensive and not very good. If you have questions about crypto, Bitcoin, blockchain, gold, any of those things we can discuss. Questions about AI, questions about the election, questions about our national debt. Feel free to book a meeting. Happy to discuss any of these and walk you through our core thesis and sort of what we're thinking about. All right, so you've seen this slide before, but returns are generally positive over long periods of time. So this is a longer term bucket. Equities, 7 years, 95% of the time they're positive. 10 years, 95% of the time. 15 years, 99% of the time. So this was done at the end of July, so not too long ago. And the average returns for 7 years with equities, U.S. equities, up 13.9% per year, 12.8, 14, and 10. So much higher than average for these years. And bonds were not as good, okay? So bonds over the last 5 years were up barely 0.22%, 7 years 1%, so barely keeping pace with inflation over longer periods of time. The good news is the current bond yield's above 5%, and actually over the last year, 12 months, intermediate term bonds are up 8 or 9%. So that has improved quite a bit, and we'll see how that continues moving forward. But we plan on inflation being around 3%. So the goal is between stocks and bonds, we want to have a real return ahead of inflation that compounds over time. So this is how we think about investing framework for people near retirement, at retirement. We think about short-term cash flow, money you're going to need in 0 to 7 years or even up to 10 years. We want this in safer assets, okay? And then the rest of the money, we want to invest it for long-term growth. So this is long only stocks via ETFs, typical returns of say 7 to 12%. But a wide range in outcomes. They can go up or down in any given year. And then we have this 4 to 7 year bucket that has some hedging, some puts calls, some long short strategies, some alternatives for a little bit better return than what we typically get with bonds. So this is how we think of this. Every dollar we invest should have a time frame with this, okay? So if we have a really bad recession, we're only going to take your retirement money from this safer bucket. And we're going to let this money over here recover for the long term. So here's a 1 year chart with some of the different ETFs we use. And you can see even after August 5th, when the market went down a couple percent, stocks were up 17% over the last year. Technology stocks did a little bit better. Yeah, they're off the highs from back a month ago or 3 weeks ago, but they're still really good returns. And you can see Ag Bond was up about 7%. Our money market was up 5.3%. So good returns even with the sell-off that happened the other day. This is since 2020. So since 2020, equities, U.S. equities are up 70 or 80%. Technology is up a little bit more. Ag Bond is barely flat over the 4.5 years, 4.6 years. So again, we want to own equities for the long term, even though they go up and down. And here's a 10-year chart. So over the 10 years, stocks are up 221% or more. Technology's done quite a bit better. Ag Bond is only up 18%, and that is not beating inflation over the 10-year period. So it's important, again, to invest for the long term. And here is since 2009, you can see U.S. stocks are up 927%. So if you had $1 million invested there, it would be over $10 million. Ag Bond is only up 52%. So if you had $1 million invested there, it would be worth 1.5 million. And then inflation's right behind it at 1.47 million. So again, we want to own equities for the long term and let it compound for us over decades. And again, you can pause any of these slides. I'm happy to walk you through this, but we look at a lot of data. This is rolling 7-year periods. This is rolling 10-year periods. And you can see S&P 500, Ag Bond Index, and then 40% equities, 60% equities, 80% equities. And you can see over 7-year rolling periods, it is positive, 99 to 100% of the time. Most of the time, the returns are certainly above 3%, okay? And oftentimes when you have equity in your portfolio, it is above 7% for compounding. So the average for the S&P 500 over these rolling 7-year periods was about 12% per year. If you had a 60-40 portfolio, it was around 10% per year. So again, we want to make those returns compound for us over time. And this is, just so you know, this is 529 rolling 7-year periods. So a large sample size, and this is why we look at the data. So we're always looking to answer the question, do we think equities will be higher 7 or 10 years from now? And really, 95 to 100% of the time, we think the answer is yes. We may have recessions in between, but we think over the long term, equities continue to grow and compound. And then here, this is how we think of building portfolios. So it's been a while since I've updated clients on this, and I'm happy to talk one-on-one. But we believe the base of the portfolio, even before this, is your health and your behavior on how we invest. Okay, is even before this investing diagram here. But it starts with beta. So this is indexing, global stocks, ETFs is market beta. Then we add factors. Factors are high profit, quality, momentum, value, small cap, dividend paying companies are factors. It typically does a little bit better than just indexing. Then we have macro bets. So this is AI, technology, software, infrastructure. And the very top part is some hedging strategies, puts calls, maybe direct indexing, some other things that we think add diversification, and reduce risk. It's a little bit more expensive, it's a little bit harder to do, and that's why it's a smaller amount of the portfolio. But keep in mind, even if you have a 60-40 portfolio, 86% of the risk in your portfolio comes from equities. Even a 50-50 portfolio, about 80% of it comes from equities. So when you see the markets go down, when you see equities go down, they can go down a lot. And that's why on a risk standpoint, much of that is driven in your portfolio from the part you own in stocks. So overall, I just want to tell clients and people watching this is pretty normal. Markets go up and down. Over the long term, they go up. We have great software that can help you have confidence about your retirement plan, confidence about modeling recessions, and really help you get from here to where you want to be and to help you to live your best life possible. So we do this with software. If you need to book a meeting with us, you can book a meeting with me or a meeting with Sam if you want to do some planning or update your financial plan. And we can help you to understand this and make sure you're properly positioned. But it all is driven from software. So we give you confidence and we help you to live your best life possible. So for those of you who are not clients, we have a free second opinion process. It starts with a discovery meeting. Many clients, new clients, say they wish they would have known this 10 plus years ago. We make it really easy for you. But it starts with a discovery meeting where we get to know you and understand your challenges and what you want to accomplish. If you like that, you can upload key information and we will gather that information and do a report for you, a free second opinion. We then book a meeting time for you. When we do the second opinion, we're going to help you identify any red flags in your portfolio. And then we'll book a meeting with you and actually give you the report, walk you through what we found for red flags and items you can improve upon. If you want to become a client, you can sleep on it and decide. We think we add massive value for clients in the $1 to $10 million plus range. And if you want to become a client, if you see that value, then we work on getting you on board at Schwab and helping you transition accounts. So book your free second opinion. We'd love to help you. And if you're a current client and you want to talk about any of these items, please book a meeting on our calendars and we will go from there. Thank you so much. We'll talk to you soon.